With the S&P 500 dropping 0.81% today, June the 17th, 2025, to 5,984 points, and retail sales collapsing 0.9%. The differences between fund types have never mattered more. While everyone debates index funds versus active funds, $620 billion flowed into smart strategies in just 4 months of 2025. I'm going to explain these investment types with the most recent 2025 data that shows what's actually working now. We'll cover what each fund does, current costs, and who they're really meant for in today's market. This isn't financial advice, but in 10 minutes I'll give you the knowledge most people take years to figure out. What is a fund? Think of organizing a massive dinner party. Instead of one person buying everything, each guest contributes money. With that pooled budget, you can afford premium food and entertainment that no single person could manage alone. That's exactly how investment funds work. A group of people pool their money, and that money gets invested in stocks, bonds, or other assets. Instead of picking individual investments yourself, the fund handles it, and you share the results. Here's what's new in 2025. With geopolitical tensions and AI disruption, the type of fund you choose matters more than ever. Index funds, the set-it-and-forget-it strategy under pressure. You've probably heard influencers say, just throw your money into an index fund and forget about it. But June 2025 data shows this strategy is facing its biggest test. An index fund simply copies a list of companies without trying to pick winners. Think of it like a scoreboard. It tracks whatever's in the index. The S&P 500 index tracks 500 of America's biggest companies. When Apple or Microsoft moves, the whole index moves. NASDAQ 100 includes tech giants like Apple, Microsoft, and Amazon. It gained 10.30% in May 2025, but is now trading at fair value. Current costs. Most index funds charge 0.02% to 0.20% annually. The Fidelity Zero Large Cap Index charges exactly 0%, completely free. Here's the problem in 2025. When geopolitical events hit, like today's Iran-Israel conflict, index funds can't protect you. They just follow the market down. All Magnificent Seven stocks fell today when Trump demanded Iran's surrender. Who therefore? Long-term investors who want broad market exposure at low cost but can handle volatility during crisis. Mutual funds, professional management fighting for relevance. Mutual funds look similar to index funds. They pool money for many investors, but here's the key difference. They are actively managed by professional teams trying to beat the market. Their goal is to outperform benchmarks like the S&P 500 by picking better investments and timing markets. The current costs are 0.5% to 1.5% annually, which is much higher than index funds. You're paying for professional management, research teams, and active trading. 2025's reality check is that active mutual funds saw $82 billion in outflows during April 2025's market chaos, while passive strategies gained $36 billion. This shows investors are losing faith in traditional active management. But here's what's interesting. 91% of Vanguard's active bond funds outperformed their peers over 10 years. In volatile markets like today's, active management in bonds is proving valuable. Recent performance. Technology mutual funds gained 10.30% in May 2025, but many are now at fair value levels. Communication services funds gained 9.59%, but remain the most undervalued sector. Who therefore? Investors who believe professional management can add value and are willing to pay higher fees. ETFs, the new king of investment funds. Exchange-traded funds are like the hybrid child of index funds and stocks. They provide diversification like mutual funds, but trade all day like individual stocks. The game changer. You can buy and sell ETFs instantly during market hours, unlike mutual funds that only price once daily at 4 p.m. Current explosion. ETFs captured $620.54 billion in global flows during the first 4 months of 2025. Active ETFs captured $132 billion, 34% of all flows, despite being much smaller. Cost advantage. Most ETFs charge 0.03% to 0.75% annually. The Vanguard Total Stock Market ETF charges just 0.03%. 2025 breakthrough. Active ETFs are growing 55% annually versus 11% for passive funds. Vanguard launched their first actively managed bond ETF, VGMS, on June 11, 2025. Real-time advantage. During today's market drop, ETF holders could exit instantly, while mutual fund investors waited until market close. Tax efficiency. ETFs are more tax efficient than mutual funds. Who therefore? Any investor wanting flexibility, tax efficiency, and real-time trading. Perfect for both beginners and professionals. Hedge funds, the exclusive club fighting back. The name hedge comes from hedging risk, but modern hedge funds are more about generating returns that don't correlate with regular markets. What makes them different? Hedge funds can short stocks, bet against them, use leverage that's borrowed money, and invest in complex strategies unavailable to regular funds. The exclusivity factor. Usually only open to accredited investors due to higher risks and complexity. Current performance. Global hedge fund capital hit $4.5 trillion in 2024, up $401.4 billion. 36% of institutional allocators plan to increase hedge fund allocations in 2025. The fee structure. The 2 and 20 model, 2% annual fee plus 20% of profits. 2025 reality. Hedge funds delivered second highest returns in the last 10 years during 2024. Statistical arbitrage and macro strategies see unprecedented demand. The recent winners are Citadel and Point72, which provide consistent outperformance through risk management and AI strategies. Who therefore? Wealthy investors seeking returns uncorrelated to traditional markets, willing to pay high fees for professional management. The 2025 data that changes everything. Here's what the most recent institutional flows reveal. Active ETFs, $132 billion in 4 months. Hedge funds, $401.4 billion increase in 2024. Market breadth improved to 53.80% despite today's decline. Vanguard's 91% active bond fund outperformance. European markets offered better value than US tech. Your action plan based on current market reality. For beginners, start with Vanguard Total Stock Market, that's VTI, at 0.03% fees. Add European ETFs currently undervalued. For intermediate investors, mix passive holdings, that's 60%, and active ETFs, that's 40%. Focus on small cap value at 20% discounts. For advanced investors, consider hedge fund access and private credit yielding, 8 to 12% versus bond funds at 4 to 5%. For all investors, avoid pure passive strategies during crises. Today's 0.81% drop shows why active management matters. The bottom line for 2025. Here's what most people still don't understand. The era of just buy the S&P 500 is being challenged by constant geopolitical shocks, AI disruption, and policy uncertainty. The data is clear. Active ETFs growing 55% annually. Hedge funds at record assets. 91% of active bond funds outperforming. Smart money is paying for active management because markets require it. ETFs are winning because they combine the best of all worlds. Diversification, low costs, tax efficiency, real-time trading, and now active management options. The opportunity is massive, but the window is closing. As more retail money catches on to active ETF strategies, the best opportunities get crowded. This isn't financial advice, it's education about what June 17, 2025 market data reveals. The passive investing era worked when markets were simple. Today's complex world requires smarter strategies. Your move. Smart money already moved. $132 billion flowed into active ETFs, while retail investors stayed trapped in bleeding index funds. Today's 0.81% drop proves passive strategies are dead. The opportunity gap widens daily. Act now or get left behind permanently. All investing involves risk. Past performance doesn't guarantee future results. Consult qualified financial advisors before investing. Please like this video and subscribe. Here's to your investing success. Profitable investing.